Great. Welcome, everybody. We are going to give you about 30 seconds to stream in since we've had a big RSVP list for this webinar. We're really excited to welcome you today. I am J.Thelander, founder and CEO of J.Thelander Consulting, and I am here with my esteemed panelists, Emily and Jim. Emily from PitchBook, who is our senior VC research analyst, and Jim Jensen, a partner at Wilson Sonsini. We would love for today to be interactive. We have an agenda that we're going to go through, but we also have somebody monitoring the chat. So if you have questions as we're going along, please feel free to write those in, and then we'll address that and adjust as we can. So Emily, you want to show the agenda next? Great. So we're going to Emily's going to do a PitchBook presentation, sort of give us a perspective on what's happening in the market with some great PitchBook data and trends. And then we're actually, for the first time, going to do a demo of the Thelander platform since we're co-branded with PitchBook, so everyone can see what the real-time data looks like. And also, we're going to give some comp data and other information. Jim is going to be our resident expert to weigh in on what he's seeing in his practice and how it relates to venture and other investment firms today and their compensation and nuances around carried interest and other angles on long-term incentives. So with that, Emily, I'm going to turn it over to you, and we'll go from there. And thank you, everybody, for joining us again.
Great. Thank you so much, Jody, for the introduction. Today, I'll be giving an overview of the current state of venture in the US, and we'll cover three main themes: deal making, exits, and fundraising. But before we begin, I'd like to spotlight the data that powers my research. PitchBook is the leading resource for comprehensive data, research, and insights spanning the global capital markets, including PE, VC, M&A, and emerging technology spaces. You can learn more about our platform and new features at pitchbook.com. So let's start off with the big picture. If I only had one word to describe the current state of VC, it would be bifurcation. We're seeing a clear market split between the haves and the have-nots. A few headline deals and exits are carrying the quarter, while activity beneath the surface remains subdued. And most notably, AI startups have been dominating both headlines and venture dollars, capturing over 70% of deal value, with only about a third of deal count. Beyond those bright spots, the market remains stuck in a stalemate due to seemingly never-ending headwinds. So let's take a closer look at deal making. In Q1, we estimated nearly 4,000 VC deals, which is roughly on par with Q1 of last year. What really stands out, though, is that quarterly deal value was $91.5 billion, which is the highest level since late 2021. This was largely driven by a few huge AI rounds. OpenAI raised $40 billion, Anthropic raised two rounds totaling $4.5 billion, Infinite Reality brought in $3 billion, and Grok raised $1.5 billion. So AI is the clear exception to what's otherwise a cautious market. Outside of AI, investors are selective, with a strong preference for quality, as evidenced by the increase in larger deals and decrease in smaller deals. For example, deals above 50 million now account for 7% of total activity, which is up from just 4% in 2023. Newer companies especially have faced the brunt of the deal-making stalemate. First-time financings have slowed down, as LPs and GPs are just less willing to take risks on new startups. In Q1, less than $4 billion was invested across 900 deals. Overall, deal-making activity is very concentrated. Quality companies, especially in hot sectors like AI, are still getting funded. Everyone else is facing longer timelines and tougher terms. Jody, do you have anything to add before I move on to exits?
Yeah, I mean, we're seeing this, the compensation is reflecting this on both. We cover both the private companies as well as the investment firms, so venture and private equity, corporate venture firms. And we can see that the mix between cash and equity is staying really stable because there's no question that everybody's waiting for the M&A market or the liquidity market to open up a little bit. So the compensation's not wild swinging, but it's also not going down. And it shows that the good companies who are still being funded are definitely holding tight to wait until there's some kind of opportunity.
Great, that's very helpful context. So now moving on to exits. Coming into 2025, there was real optimism that we'd see a rebound in VC liquidity. The IPO pipeline looked promising with filings from startups like crypto firm Gemini and defense and space tech company Voyager, both of which are well positioned to benefit from the Trump administration's key policy themes like crypto and American dynamism. But tariff uncertainty has caused some startups that have already filed to delay going public. This quarter's exit value hit 56 billion, which is the highest since Q4 of 2021, but this value is highly concentrated. Only 12 companies went public during the quarter, with CoreWeave being the lone unicorn, doing so a week before the tariff announcements and single-handedly generating nearly 40% of Q1's exit value. So even though the initial shock from Liberation Day has started to wear off, and a handful of unicorns like Hinge Health, Mountain, Circle, and Amada Health have gone public in Q2, IPOs will not likely be making a full comeback in 2025, and we may see a modest uptick in the last quarter of the year if some major policy questions are answered by then. The secondary market has been hailed as an exit alternative during these times, and in Q1 swung in favor of sellers, with both average and median discounts flipping into premiums in January and closing the quarter at 6% and 3% respectively. However, this value is inflated because secondary transactions have been disproportionately concentrated among top startups with the highest valuations and the highest investor demand. So, medians are high only because most startups aren't even being represented in this data. Based on activity over the last 4 quarters, the direct venture secondary market size is estimated to be $60 billion. In context, 60 billion makes up less than 2% of total unicorn value and only a third of primary VC exit value. So, secondaries remain a relatively small slice of the broader venture landscape. On the bright side, secondaries do have strong potential for growth. Dry powder figures have more than doubled since 2022 for venture secondary funds, totaling nearly $10 billion as of September 2024. Though, for context, this is still only about 3% of the total dry powder that's allocated to primary VC. A lot of this growth is fueled by demand from new venture investors like family offices and pensions who view secondaries as a more accessible entry point to the asset class. After all, secondaries require low minimums and shorter investment timelines, and you're investing in late-stage startups that already have a proven business model and promising exit outlook. So buyers do get less upside, but also far less risk. Jody, do you have anything to add on exits?
Well, I have two things to add also. One is on the exit part. Yes, that we're seeing just later stage companies staying private longer. I mean, we used to, in our private company data set, have 90 million plus is the total amount of financing. And now we're up to over 400 million plus because more capital, as you said, is going into fewer companies and they're staying private longer. But the other part that we've really had some exposure on is the family offices, and we have been tracking their compensation. I'm sure, Jim, we can get into this, but we're seeing family offices be also like venture firms more and more. And then it's not just the families that are working there, but it's also that they're hiring people from outside the firm because they are getting into the private capital markets in a different way than they historically have, just managing family money. They're looking to get into the investment areas of other portfolio companies.
Great. Thank you for that helpful context. And now let's move on to fundraising. So, speaking of dry powder, fundraising continues to be the most constrained part of the venture ecosystem. Only 10 billion was raised across less than 90 funds in Q1, and if this pace continues, 2025 will be the weakest year for VC fundraising in over a decade. A big reason for this sluggish pace is liquidity or the lack thereof. LPs just haven't been seeing meaningful distributions in years, and that has made them even more cautious. Those still allocating capital prefer large, established managers with strong historical returns. Performance is playing a bigger role in LP decisions than ever. Managers that have raised a new fund since 2021 are consistently outperforming firms that have not, which is yet another example of this broadening gap between the top managers and other venture investors. The dominance of established funds will likely continue until there is a greater and more consistent flow of dollars. LPs need to first recoup their deficit between capital calls and distributions from the last few years before committing to more investments. Jody, anything to add on fundraising before we move on to the outlook?
Well, again, Jim and I are going to get into this. Yes, we're seeing this. And I know, Jim, we were discussing that you're seeing the emerging funds are struggling a little bit. And also, we're seeing that the vesting times for carried interest have been getting longer compared to previous years. And the carry distribution is going, is there's more carry going in the firms to the top levels and also to the lower levels because people, you need to allocate to keep the staff, to keep the partners in these firms engaged because the liquidity is taking a longer time and they just haven't seen as much in the past year.
Great. Thank you, Jody. And moving on to our outlook, as we look to the rest of the year, we expect policy developments, especially around tariffs, to play a central role in shaping venture sentiment. Until more clarity arises, political volatility and market swings will keep recovery and liquidity just out of reach. This is a tough pill to swallow for the asset class, which has been stuck in a stalemate since 2022 and desperately needs exits and a greater flow of capital since over $3 trillion in value is locked up in unicorns. But there's still reason to believe that if macro conditions stabilize, we could see the beginning of a recovery by the end of 2025. As I mentioned earlier, multiple notable startups have already filed for an IPO, and they're just waiting on the sidelines until the stock market calms down. And hopefully, their exits will be the catalyst that venture desperately needs to spur more activity. We'll be watching closely. Thank you for your time, and now I'll turn the discussion back over to Jody.
Great. Thank you, Emily. So, as I said, for those of you who have joined us since we started, we'd love this to be interactive. So, we've got somebody monitoring the chat. And I'm going to go ahead and we've had to segue, we have had a partnership with PitchBook for 10 years. Thelander and PitchBook, and we are the only combined firms who cover the global capital markets on all aspects of both, as Emily really highlighted here, the PitchBook data on deals and what's going on, who's raised money, where the money's going, who the LPs are, who the partnerships are. But the one piece that Thelander covers that PitchBook doesn't is the compensation. And so all PitchBook clients have access to a subset of the real-time Thelander data as part of their PitchBook subscription. So you have that active as long as you are a PitchBook client, which is great. And so if you want to activate that and it's the first time you're hearing about it, you can, Morgan's going to put in the chat, it's pitchbook@jthelander.com. Just email us and I'm going to share what this looks like. So you understand also context of where the data for today's webinar is coming from. So this is the Thelander platform, and you can see up top that this is the private company data. We have three sets of data: private company, investment firm, and hang on one second there. Let me log in again. Must have bounced me out. And we have three sets of data: private company, investment firm, and we also have the corporate venture data. And all three sets of data, as I said, are real time, and that data is updated daily. So here we're going to go ahead back to the platform. Okay, great. So this is the private company data, and you see if all PitchBook clients get access to exactly what we're showing, which is a subset of these results, right? And we can look by all the factors that really influence the private markets, which is total financing. Some people prefer series of financing. And then looking at the valuation region, which I'm not a big fan of because it can be hit or miss revenue, and then company headcount. And we also have every single set of jobs, C-suite, VPs, directors, and staff level. And again, this is for the private companies, for the portfolio companies of those of you that are here. And then the investment firm data is a same concept, right? We have the job, the region, assets under management, which is very important. Jim, maybe you want to weigh in on this, right? We look at assets under management as really the best way to look at the comp data for investment firms.
I think unfortunately it is one of the key drivers because firms with a lot of AUM have the ability to pay outsized salaries relative to the small firms. I think the other thing is that the percentages of carry that a recipient of a large firm would receive is probably lower, but at the same time, it's more dollars of carry potential to them just by the AUM. So there's
Yeah.
clearly an advantage of working at those firms from a compensation perspective, and it's just kind of the economics of the fund.
Right. The bigger the fund, then you have access to more capital. Okay, so here's the last piece of it I'm going to show, which is so the platform really complements PitchBook in that while you get to see what's happening with deals and funds, then on this side, you can go ahead and look at the compensation data, which is why it's important for firms to have access to all of this. And again, this is complementary, so it's great. And then the last component of all of this, you can see all the jobs that we have because we go down through analyst, asset manager, and receptionist, right? So this is really important. You see the different lines of the compensation, base salaries, bonuses, total cash, target bonus, and then of course, as Jim was talking about, the percentage of carried interest. And then the last piece of it is the corporate venture firms who are really strong partners in this investment ecosystem. And it shows you here, again, a list of the different types of positions that we have. And you can also look by total corporate venture investment capital under team management. And the last thing we have is now we have year over year trends and comp planning because it's really important. And we understand the optics today, right? Is that you need to know how has history, right? I mean, we're in a little bit of a tricky market, but we know that we're going to come out of it because the investment firms are a healthy part of the ecosystem, can't go anywhere, even though it may be challenging right now. But in having the historical data and showing, we have some of this for our webinar today too. So you can look at the past and look forward, which is really important. And then we also have the comp planning, which allows you to figure out, how you want to go ahead and make your compensation in your firms competitive. And that's also really important because we had a question come in, by the way, is if you already have a PitchBook subscription license, yes, you get this. So just email pitchbook@jthelander.com. And Morgan is going to put that link right up. And yes, you get access to this as long as you're a PitchBook client. This is yours for no charge. So that is something that we've never really done a demo before, but it seems right now that all of this information is really important because it works in lockstep and it's more important now than ever. So I'm going to go ahead also and jump into the rest of some other comp data and give us some information that we can use for the crux of this conversation. So I think you've seen here about J.Thelander Consulting. Won't get into more of this. We're a compensation data and consulting firm. We only cover the private capital markets. Here's a list of the different types of firms that are included in our survey, and that is venture and private equity, corporate venture. We've gotten a little heavier into both hedge fund and as well as family offices lately for obvious reasons that when the market is a little pressed like it is now, the need for comp data seems to be ever more important, as well as we also have the private company data. So we cover the whole investment firm ecosystem. And as what Jim and I discussed, the assets under management, really important. And you can see, again, we have grown in terms of our asset classes, the 7 billion plus. We used to just go up to a billion plus, and then it was 2 billion plus. And now this group is looking more and more robust because, and maybe Jim, you want to touch on this. The good firms are raising more capital and the new funds having a little bit of a problem or just taking longer.
Yeah, I was depressed by Emily's data that showed that only 10 billion has been raised this year. But now I know, like I talked to two clients this morning that were raising their next fund and were optimistic and how's the market. And the reality is, I think that if you're an A branded firm, whether you're clearly an A or, have the brand of an A, fundraising is really easy. There's capital that's out there that needs to be deployed and invested. If you're an emerging manager, it's much more challenging. Even if your IRR may be better, even if you may produce better returns overall for your investors, it's really challenging. I think one, you don't have access to those big checks because they don't want to invest in emerging managers. And kind of two, it's the family office and others are kind of pulled back and are more conservative. So it's unfortunate, but it just means look, this market has cycles. And if you just hang in there, you take a longer time to raise your fund, eventually it'll happen. It just is a more challenging market. And it has been, Jody, I think now for a year and a half or so, you
Yeah,
know.
slow and steady is winning the day. I was just at the Wilson had their MedTech conference in San Francisco last week, and we did a panel on compensation. But we also had the luxury of being able to listen to all the speakers, and it really says, just like what Emily had indicated, that it's a platform of the haves and the have-nots, and the firms that have done well are continuing to do well. New funds that have operators who have come from successful exits are also doing well. And there is a healthy amount of talent available. So let's get more into the comp data a little bit. This is talking about, because we do have a lot of global data these days. We've been covering in the UK as well as Europe in terms of portfolio companies and the investors. So you can see that the bulk of the firms are still in the United States, but we are covering globally nicely. And then within the United States, just for optics here to understand that it really covers all of the US, and it really does not matter where your firm is located. It can matter in terms of compensation, but in general, the assets under management are the best way to cover differences in firm size and for different folks. And within Europe, again, just to give you a breakdown. Okay, so let's get into, we showed you a list of the investment firm positions were on the platform, and some of these were shadowed because the silver subscription that you get gives you some of the data, but of course not all of it. A lot of jobs that are covering the portfolio companies, so you can see this, and also covering the portfolio companies from both the VP level as well as director level, manager level, associate level. And now more than ever, I think, in terms of keeping the portfolio companies successful, that there's more of a hands-on approach in general with firms. I know not every firm has that approach, but many do. Okay, so let's get into the good stuff on the comp data. We're going to just go ahead and give a definition, Jim and I, on what compensation looks like in investment firms and the different levers. So on the cash side, base salary, and then you can have a bonus that was actually received. We consider that to be the current bonus. And then a target bonus, which is out for the year, so a short-term incentive, but that is not yet received, and we don't count that as part of the compensation yet. And that gets you to total cash. So total cash can be a combination of base salary and if you received a bonus, or it's just your base salary. And then Jim, you want to speak to the carried interest, carry dollars, equity components?
Yeah, but let me first kind of like split carry into kind of two different types of carry. Is one is carry that's deal by deal, and that's kind of the equity distribution, and then carry that's overall performance of the fund. I think most commonly, if you're talking about professionals that are part of the team, it's carry overall of the fund. And what carry is if you think about the general partner's capital commitment to the fund, the general partner receives a disproportionate share of the profits of the fund that's unrelated to its capital commitment. And that number is usually 20%, and Jody's going to get into that. Carried interest dollars of work is something where if you're, I would say, not the most senior people in an organization, in an investment firm, sometimes you're offered carried interest dollars of work, and it's easier to visualize that, I think, for a lot of people. I think it also hides the fact that your percentage of the total may be smaller than what you hoped for. So carried interest dollars of work is if you have a $100 million fund, you assume it's going to return 2x, and you assume like 20% profits carry in that. If you to return 2x, there's $20 million of profits. If you have $1 million of carried interest dollars to work, you make $1 million over the term. you assume it doubles. Now, if the
People
fund
like the
performs
carry
better,
dollars at work because it can seem a little bigger because at the younger positions or the more junior positions, you don't get a lot of carried interest. And so as a result of it, those numbers aren't as robust. So carry dollars at work sounds like a bigger, it's more of an incentive.
right?
Okay, so I'm going to show some data right here. And I have a lot of slides, so I'm going to flip around here and go down so that we can move to what seems to be more timely. So here is the year over year cash and carry for a managing director partner for all firms under $1 billion. So this could be, I mean, it's unlikely that it's much of a private equity firm because most have larger AUM, but you can see this is from the comp tool on our platform looking at the year over year data. So you can see that the total cash, as we know, there was a little bit of a peak, and the total cash again could be base pay and bonus or just base pay. This does not include if there was a carried interest distribution. And so you're now back up at the $400,000. It dipped a little bit, 23 and 24. And then this is the percentage of carried interest. And the percentage of carried interest, as Jim said, is based off of the 80-20 split. So, and here's another data set on that for those of you that are watching the webinar and saying those numbers look low. Well, here's the 75th percentile. And you can see almost right on the money that things are back up again. So while, Emily in the PitchBook data sort of talked about the markets being tapped down, I think this is a firm stance to say, listen, we're not going anywhere. And we also know that we've got to pay people. And so maybe these dips are fine, but we need to go ahead and increase our compensation and get the total cash up because the carried interest is taking longer to turn into any capital. And let's see, I know we have a question talking cash comp is base salary or includes bonus. Yes, it depends. It could be just cash compensation if you didn't get a bonus, but if you did receive an actual bonus, then it is both. And I'm going to go back here to look a little bit, like here's another position. Okay. I think this might be of interest too. Okay, so we're just going to run through some comp data because we know everybody likes that. So here's a senior associate private equity versus venture capital, and this is the $1 billion plus. So the private equity pays a little bit more and the carried interest a little bit more, but not tremendously. And again, this you can see for especially in line with the question that was just asked, the base salary plus the current bonus does not add up to the total cash because not everybody is getting to their total cash from base salary and a bonus. Some people are just getting to it from their base salary. And here is a senior associate 75th percentile carried interest. And you can see, Jim, maybe you want to speak to this because this is what you would expect. So the larger the AUM, the smaller the piece of the pie.
Yeah, absolutely. But the total return from those carry dollars could be a lot higher because, the thing you have to factor in, I think, with some of the larger firms is that maybe their target, they'll say their target is 3x, 3.5 times, but very often those funds perform 2x. And if you have a percentage with a smaller firm and the firm hits 4 or 5x, you may be doing better off. So I think you really have to, when you're thinking about your comp package or choosing which firm to join or stick with, you have to think about the return profile, what it historically has been, as well as your percentage, et cetera, and your base comp, and kind of, calculate them all together. But what we said is your percentage of larger firm is going to go down.
Yeah. And then here's another slide just to give you a sense of it, right? Because this is for like a CFO, an administrative position, which can go across all different sectors. And this is where you can see the comp levers in play, which is the base and the bonus and getting to the total cash and then the percentage of carried interest. And we show you the median 75th and max because a job like this is really tied to the firm personality, right? And we had a question come in saying as firms move to push more carry to investors as the street it values it less than base fees, what's the trade-off, if any, seeing between carry allocation and annual compensation? And I have a thought. I'm going to show some data on it, but Jim, in the meantime, do you have a thought on that?
Not necessarily, on the CFO, no, not specifically.
Okay, so here is the, let's see, general partner. Let's see this up for director principal. So we're seeing that let me pull this up, that some of the data is showing that the carry is increasing. So here is another, here's the, for a director, I'm going to move from the director principal to a pre-MBA analyst. So this is a perfect example, sort of, is pushing more carry to investors. This is a job, though, that's feeding a firm, right? And if you have a solid firm, an investment firm, and you need to keep these people engaged, they're actually giving you a little more carry because we know it's taking a longer time for the carried interest to have a liquidity. And so, and the annual compensation going up as well. And this holds true at the top job, and it also holds true at these more junior positions. So here is the 75th percentile. And you can see, so top people coming into a firm where they may, even though they may be more junior, but they're really going to add value. You can see the cash is up a little bit, and so is the carry. And then there's a position, let me find it, the director position where the director principal, which is sort of in the middle, where that's not happening. And we study all of this, and it's really interesting to see. So here is the director principal, and you can see the cash is a little bit staying constant, but the carried interest has gone down both for the median as well as for the 75th percentile. And these are the jobs that are sort of getting squished. So at the top levels, right, at the managing general partner level, we're seeing that both the cash and the carry is going up, and also at the younger, smaller levels, the more junior positions. And that is because it has really gotten to be such a long game, big picture. And that is, and the better way to look at this, I know we've had questions coming in about geography and about other questions, but really the best optic is the most strategic optic. And it's the same for your portfolio companies, but for the investment firm level, looking by assets under management is really the best way. If you get into geography, it may impact the compensation for one job, but it will not be the same for every single job, if that makes sense. So it may be higher for one role, but it won't be higher for every role. And it really just depends on the compensation and the competition for talent in that area. All right, I'm going to show, let's see. Let's move into the carried interest investing. I know these conversations always get so great, and I want to make sure we have enough time. So here's the carried interest investing, and this is what Jim was saying. The 80-20 split, 80% from the LPs and 20% for the GPs. And Jim, feel free to jump in if I'm missing something here. And then let's talk about this. Vesting time for carried interest. So Jim, are you seeing this for later stage funds, for bigger funds? What are you seeing this for in terms of the vesting getting longer?
Yeah, like I would tell you, like my view of vesting for funds is that the term of the fund, 10 years, is the most common. So this data actually is not, is different from like what I view as like market for that there are bringing in. I think it's because when you think about vesting for carried interest, if you're a core member of the team, you're going to vest over the 10-year term. If you're a junior member of the team, they say, if you're at a startup, you have a 4-year vest, so maybe we do something similar to that. If you're somebody that's like a venture partner that's just part-time, maybe you have a 2-year vest or no vesting at all. And so I think that gets aggregated in the data that, skews it, that it's not all 10 years. But I think just general in market, whether it's large or small,
Yeah.
longer vesting terms are standard in venture capital.
Yeah, I'm getting longer. So you can see here on the year over year data that the 4 years is going down, the 7 years has gone up a little bit, and this 10-year is the one that's gone up the most. So this is only for venture, which makes a lot of sense. And then we get this question a lot about, is the vesting equal each year or does it change? Give us your sights on this, Jim.
It changes. Is that it's consistent year to year, like for in my practice, like what the breakdown is. But during the investment period of funds, there's generally accelerated vesting where there's a disproportionate share that vests during that time period, whatever that time period is. And then over the rest of the term of the fund, it vests at a lower rate with the theory that more of the work is done during the investment period. And
Right.
once you're done with the investment period, there's less work, but there's still work. I mean, you're trying to get to exits. You're still trying to manage those investments and deal with their employment issues, et cetera. So there's still work there, but you do have this disproportionate share of vesting at first, and then a lower share after that, and then generally within those buckets, even amounts per year.
Yeah. And then as part of that, also there's usually a capital commit. So we have a couple slides here, but it is by type of firm, venture versus PE versus other investment firms. So generally the capital commit, and again, Jim, if you want to talk us through this, tends to be in that 1 to 1.3%.
Yeah, and the like if you think about the GP has a commitment very often of 1%. And then Jody, I think you're going to get into like how do you break that down between members of the GP, but it's very
Yeah.
common. Now, some early stage funds, you may have a 2%, you may have a 5% GP commit because your
Yeah.
LP is like, look, we'll come in and take risk on you, but we want more skin in the game.
Yeah, here we go. So what percent? I'm going to get to the slide that has this on it. So this is talking about what percent of the data, what percent of the capital commit for the most recent fund for their carry. And so I know you always say that this is tied to the amount of carry. That used to be sort of the rule of thumb that the percentage of carried interest you have was also tied to the percent of capital contribution that you had. But we're also getting questions saying that are we observing that funds are having a larger percentage of vesting tied to the final realization? I'm not seeing that. I don't know, Jim, what you're seeing.
I don't see that either. I
Yeah.
find that like most of it is time based. It's just easier to manage and easier to monitor. So I don't see it a lot where it's kind of performance based, tied to exits, et cetera.
It's tricky. We work with a lot of firms on the consulting side. And as we were saying, we've been really busy with the good firms are making sure that they have a formal compensation structure. I think with the advent of all of these new positions and having more data, it's no longer a guessing game. And firms, in order to be stable, it's all tied together, right? The stability of the investment model, the stability of the portfolio companies, the stability of the relationship with the LPs also goes to the stability of the actual firm structure, which now has a compensation component because we understand that venture is in the economics of this, it's all tied together. And it's important to make sure that you have ranges and you have the ability to promote people. And it's not just, the people at the top getting rich and everyone else has nothing, because there is a whole infrastructure of end-to-end services for portfolio companies as well. Maybe we could talk a little bit about the waterfall and explain to us what this is. So here's the question. You have a waterfall. And I know, Jim, we've added this question about maybe if you could explain the European versus the American waterfall.
Okay, so this is just within your fund agreement in getting your carried interest. Is it European where you have to return capital back to partners first? Or is it American where you have to return the cost basis back first and you can receive carry on a deal by deal basis? The interesting thing about this data is that in my world, almost all are European waterfalls,
Right.
Or maybe it's 80 to 90%. You have 28% here, which,
Right.
is more like, look, if you're an established firm, a European firm, you may be able to have that, but that percentage actually surprises me because most funds we work with have European waterfalls.
Yeah. I'm going to skip the carry dollars at work for a second because I think the equity distribution program has gotten to be more prevalent today. I mean, we've been working on a number of projects where they've asked us to figure out a formula for the equity distribution because the fund is taking so long to return and people want, but one portfolio company has done well. So that's sort of, it's really in addition to carried interest and for higher ranking positions, this is a component of it. And Jim, how are you putting these into place? What's the structure?
Yeah, most of these we do honestly is just like straight bonus programs where the carry's taking longer, exits are 10 plus years.
Right.
You need to give people incentive. And so you're putting some sort of bonus structure in place based upon the net asset value or carrying value of the fund that you're paying out more. And if there's no exits, those come all out of management fees. But that's
Right.
essentially kind of what we're doing. And most of those we do like where they renew every year. If you're there, you get it. If you're not, you don't get it.
You got to be present to win. We had a question on that actually on the carried interest about needing to be present to win. So how does that work?
So generally with senior person carried interest, it vests over time. If you leave, you keep your vested portion of it. Maybe it declines over time, but more often not. If you're a more junior person or very junior person, often what you think of as carry is phantom carry. And essentially,
Right.
if you're there, you get it. If you're not, you lose it. And it's often an annual like updated grant where you're like, okay, if it happens this year, you get X. That if you do well the next year, maybe your percentage goes up.
Right.
But that's generally like how it works. And like in private equity, you often lose after you leave the firm, like over a period of time. In venture, you typically keep it if you're a
Unless it's,
senior
I mean, I've
person.
had some clients where it's been written into the specific fund that you have to stay
Hmm.
to keep people engaged and keep them there. The problem is that's why I think there's more uptick on the equity distribution side, and we do see it as cash as well. Um, I'm going to move into one. I guess we'll go back. Let's go to the carry dollars at work because I think people care about that. And then we also have let's see, we also have a component on, hang on one second, on firm structure and sort of how long it's taking to get to promotion, because I think that's been really relevant for firms today too. But here's the carry dollars at work. So let's cover all the long-term incentives here, or the different ways. So that's the 2x and what you will receive. So it's not a guaranteed, right? I mean, none of it's a guaranteed, but it's if it returns a 2x. So here is how many carried interest dollars do you have at work across all active funds for a managing general partner? And you can see that with the assets under management, 50th and 75th percentile, obviously, the higher the AUM, the higher the carry dollars at work. And here is for a managing director partner, again, for the assets under management, the different categories. So explain this to us again. I know you gave us the analysis or the definition in the beginning, but here you have realized data.
Yeah, the interesting thing here is that often I would think of a managing director not having carried interest dollars to work. I would think of them having a percentage of the carried interest. So if you think about carried interest as 100%, some of your earlier slides, Jody, said that that person would have between 8 and I think 15% was the data I saw on those slides.
Yeah.
Like the carried interest there in the chart you just showed is like a managing director would have like $5 to $7 million, which means that if the fund 2x's 100% profit, they make $5 to $7 million over the term of the fund, which tend to be 10 plus 1, 2, 3 years. So that's what they would earn. Very
Right.
easy to understand it, but typically with the senior people, you give them a percentage, not carried interest dollars at work.
Right. Here is, let's see, I'm going to go back to their CFO, general counsel. Okay, well, this is the job everybody usually likes, is the talent partner. So let me share this. So this shows you exactly, like, here are the comp levers for talent partner venture, and we show it as a percentage of carried interest. And we do get in, like you were saying, we show both we have the data in our decks on both sides of this. So this talks about the comp levers, but we don't show the carry dollars at work on this table because there are separate questions that are asked on that, because usually, like you're saying, it is a percentage of carried interest. And people, do you find that firms do it both ways, or
Yeah,
one in lieu of the other?
I see that they do it both. For the ones that do carried interest dollars at work, I think for junior people, more often they do the carried interest dollars at work. And then for senior people, they do it as a
Right.
percentage. And
And you
so
can
I do
see
see
here.
it both ways.
Yeah, so we show you the total cash and this is where listen, the data is only as good as you know what to do with it, because there's another component of this. If you're looking at the firm individually, and the job within it, then you've got to understand what's the capital contribution. And not every job has a capital contribution, and not every firm requires a capital contribution. So when you look at these higher numbers of the maximum, let's say for a talent partner of 1,200,000, it's very possible those max numbers are because this person has to contribute capital for their carried interest percentage. And as the vesting times are getting longer and the liquidity is taking longer, that doesn't mean the capital calls are slowing down, right?
Yeah, I always find this data fascinating because the talent partner, 2.5 to 6%, like, wow, I had no idea. And like the CFO, who, generally are the ones that are kind of kicked around in firms like the general counsel, was like 2.5, 3.5%. So it shows that there's still a war in talent on good people. And now with the number
Absolutely.
of firms, one can jump to another, you got to pay people.
And also, people have to produce. And I'm not surprised with the talent partner because you saw all the jobs that we've added that are portfolio facing. And the talent partner usually is portfolio facing as well, meaning they're helping to recruit for portfolio companies. And this is exactly, and Emily, I don't mean to put you on the spot, but the PitchBook data is showing that the deal flow is slowing down, right? That the fundraising is going, more money is going to fewer companies.
Yes, I agree with that.
Yeah, and as a result of that, the firms inside the roles of which, as I said, we now have VPs, directors, manager, every level of position, and not only investor relations, but things that are very portfolio facing or business development and marketing, so that they're looking at other co-syndicates and partners and bringing in the right people for a portfolio company to be successful. Because the days of companies just raising cash real quick, it's not happening. And it's not only about the teams and the talent, but it's also about the pieces that go into it, which are the compensation. Let's look at Europe for a second compared to this, right? So this is total cash for managing general partner Europe versus the US. And in general, you see this includes the UK, are lower. And you can see it. Look at the max numbers, right? Europe is staying pretty stable, and the U.S. a little bit in lockstep with this, United States, but the max numbers are much higher. And this is total cash, and then this is also the percentage of carried interest. Not quite as big of a difference, but again, this is where geography matters to answer some of these questions about that. Is we've done quite a bit of consulting on both sides to see what's happening globally, and that's where the big differences are. As an aside, we do have, let's see, pull this up. We have a great podcast out called Caplander, All Things Private Capital Markets. And we've had a number of VCs on already and CEOs. So, and it's nice because it's like 15, 20 minutes. So it's just enough to keep you engaged if you're doing a workout or driving to work. So check us out. And that's with my daughter and myself, Morgan. So we try and address all these things into sort of smaller bites. Okay, let's talk about sort of what's happening in firms with promotion and how long it's taking for people to move around because it's a little bit slower right now. Okay, let's look at firm structure and promotion. So how much does the firm structure matter in terms of the compensation, Jim? Like, how people, first, let's talk about, hang on, I'm going to move to a different slide, what the structure is like with the number of people in one position in the front versus the back of the house.
Hmm. It's an interesting question, and I would throw a wrinkle into that. Is that I think the sharing of compensation greatly depends on whether it's dominated by one or two founders or if it's a more egalitarian firm. Like if it's dominated by one or two founders, they take the lion's share, in my
Right.
experience.
And our data shows that in the beginning, that's what it looks like. And then in the middle, it starts to spread out, right?
Yeah, I mean, once you add more people and you have to bring them in, and you have to say, look, treat them as equals, et cetera, they start to not only get better comp, they become members of the management company, et cetera. And those are part of the negotiations. But to start with, it's a struggle. Like if you're a member of that team and you're pushing on a founder or founders to give you more, you find that yours is disproportionate less. And it takes a while to change that.
And what about at a later stage, like a larger firm with a big assets under management? What are you seeing in terms of the structure?
The structure of the comp is, usually base or bonus, like you say, and then carry. And very often it is more spread out, but there still often is between the senior people and the junior people, it's drastically different, obviously. But it is more formulaic. And I think you probably,
Yeah.
Jody, with your consulting, you go in there, you do the consult, you say, look, if you're in this class, you get this. And it tends to do that. And smaller firms, there's big disparities
Well,
in
you can
what,
see our data shows that if you're not getting promoted and you're not hustling inside of a firm, then because this data talks about like for a senior associate, right? This is the firms that are trying to grow the talent. That if you're not getting promoted in the 1 to 2 years, you can see the people, their compensation's higher. And this is what's happening today, that firms don't have time or interest in carrying senior associates, associates, even director principals that are not going to get to that next level of promotion. So it's either happening fast or your compensation is staying, for the more than 2 years is staying at a level that's almost getting stagnant. And we can see this the same thing for director principal. The numbers are almost consistent. There's a little bit of a wrinkle in that less than 500 million AUM, and that's just probably growing pains of like what you're saying that firms are trying to figure it out. But all of a sudden, the cost for these folks are starting to weigh in, or the carried interest is starting to weigh, curb into the top folks, and you've got to make decisions because this is really a sort of an eat or be eaten, right? Here's the associate component of that as well, is that you can see in most cases, especially in the billion plus, if you're not making more money and getting promoted, then the writing's on the wall. And this is where more and more, because there is comp data and because you have access to seeing all this, there's really no reason why you can't get your hands on what you want your firm to look like and where you are in your career. Um, as we wind up, Jim, fill us in on or share with us sort of your thoughts on what you're seeing going out on the horizon. Emily was sort of cautiously optimistic, and at the Wilson conference, everyone else was cautiously optimistic that you've just got to stay the course, stay focused, and make sure that your work speaks for itself and that you've got your house in order in all aspects, both the legal side as well as the comp side.
Yeah, like I have to, I think everybody in this industry has to be optimistic because if you're not, you're in the wrong industry. There's going to
Right.
be ups and downs. I've gone through various bubbles, from the dot coms to clean tech to crypto to, now back clean tech again and now AI, and it's going to go down too. So you just have to like stay the course. I think you have to be patient. I think you have to grind it. And if you do, it's like a fantastic industry to be in. The IPOs will return, the fundraising will return. It's just a matter of time. I mean, I thought it was really interesting. Like Emily brought up some unicorns. Those are not normal unicorns. I mean, they're billion-dollar valuations, but they're low billion. Those are not like the home run exits that people are talking about. But those are the IPOs that are going out right now. But I think that we're all optimistic the market's going to stabilize whenever that is. And then the market will open up again and it's good for everybody. But you just stay the course. And if you do and you're patient, the market will return.
Even look at Omada Health that went out. I mean, Emily, you mentioned them. No, I mean, I know that CEO, and they've been around a long time, but
They have.
patience, and they stuck with it, and it was hard work, and they did well.
They have. And I have a couple questions from the audience. Jody, is now a good time to bring those up before we
Sure,
wrap?
let's do it. Well, before to be sensitive to everyone's time, let me know.
Yes. So first is, are you all seeing any firms that have a vesting schedule where if you leave, even if you've hit vesting hurdles, you lose all your carry?
So we see that if you're not vested, you will lose your carry. And in some cases, even if you are vested, I know of certain situations where you still lose your carry. You've got to be present to win. And Jim, you were saying that in general, if you're vested, you take the carry with you.
Yeah, but I have seen recently, and I've had clients that have asked me to put in that it either declines over time or it's almost like you vest in it, but you really don't vest in it unless you hit another hurdle. So it's almost like a hidden second element to the vesting.
Right.
So it's clearly becoming more complicated to try to have the allure that, oh, you get this, but you lose it if you don't stay. I mean, to people want to hang on to talent. I mean, it's painful to have transitions, so they're trying to hang on to it that way. I think the other thing with it is they're trying to avoid putting non-competes in agreements that may be
Getting
uncompetitive,
harder and harder everywhere to have a non-compete.
exactly. So they do it that way, like a penalty on you don't really get the carry if you leave. And so they want you to stick there, and that's their effective non-compete.
Wow. The second question is there any information about private credit?
We don't get into that. Jim, anything from you?
Yeah,
No.
No.
I do not represent private credit funds, so I wouldn't have any insight on that.
Yeah,
And
the
then
only thing
the
we're seeing is the competition for talent across all of these funds. We had some slides, we didn't get into them about where people are going and where people are being hired from. And it's a pretty open trough right now because just like, Jim, what you said, There's a premium for good talent. Our median numbers in general have stayed really stable, but the 75th percentile numbers have been going up and the maxes too. And that is because good people, and you saw this with the rates of people getting promoted, right? The hotshots who have been there 1 to 2 years are making more money than the people who have been there longer because good people get promoted and they get paid. And knowing this information is why we do this is we want you to have resources so that you have a firm structure and that all of you know what the competition, what the market data is showing you, so that if you're getting a lower offer, you know there's probably not a big value for that job inside of the firm that you're working with.
Yeah, you
Great.
made
And
this
then,
comment,
okay.
Jody, where you said earlier the competition, and you're starting to look at family offices. I mean, family offices, their performance is underperformed, so they're trying to take away good people from venture firms to say, look, we're going to pay you compensation, incentive compensation, but you got to come and work for us. So I think the talent is not only within venture and different funds, it's now in family offices.
Correct. It's all over the investment firm ecosystem. Emily, there was another question.
Yes, there's one more. For from the audience, at least for now, is are you observing more funds having a larger percentage of vesting tied to final realization?
We're seeing, I think we addressed this, we're just seeing straight vesting. No, nothing more so what Jim was saying about if you leave or what, other hurdles, but with the vesting's a straight vesting schedule.
Yeah, I'd be skeptical of that fund. I have not seen that. And it sounds, given the final exit may happen in year 13 or 14, that one scares me a bit.
Yeah. Great. Well, as a wind up again, all the data came from the platform. The platform has a silver subscription for PitchBook subscribers, so we're very excited about that. Just sort of making sure that's really well publicized. Emily, thank you. PitchBook data, just nothing better in the platform. Jim, Wilson, your expertise. That we really don't have anybody else on these webinars because you just do such a great job and you say it so naturally. So. Um, Thank you. And thank you to everyone who is listening. We'll send out a recording and make sure that we